Everyone knows the folklore of Warren Buffett. He still lives in the same Omaha house he bought in 1958. He drinks cherry Coke, and he sits on a fortune of $148 billion. For decades, the financial world has attributed that wealth almost entirely to his legendary ability to pick winning stocks. But researchers at AQR found a contradiction. They stripped down Berkshire Hathaway's entire record and discovered that a standard fund manager making the exact same stock picks as Buffett would have generated only a fraction of his wealth, falling massively short of his historical returns. This enormous wealth gap stems from the specific financial structures surrounding those assets. Buffett spent 70 years engineering a corporate machine designed to plug the three leaks that destroy normal investors: fees, forced panics, and taxes. Infinite compounding requires a leak-proof container, regardless of the cargo inside. The engineering started in Omaha in 1956, when a 25-year-old Buffett launched his first investment partnership, using exactly $100 of his own money. He bypassed the standard management fee, the typical wage for an investor, and instead took 25% of the gains above a 6% yearly hurdle. This is known as carried interest. Rather than pocketing his cut, his pay stayed in the pot to compound at the same rate as the rest of the fund. By leaving his cut inside, his $100 ballooned into $25 million in just 13 years. But this early machine had a flaw. The money belonged to clients, meaning they could demand it back at any time and force Buffett to sell off his best assets to pay them. A piece of ownership compounds while you sleep, while a check for your time stops the moment you stop working. In 1969, Buffett closed his successful partnership entirely and rolled his personal wealth into a dying New England textile maker he had purchased out of spite, Berkshire Hathaway. By becoming a controlling corporate shareholder instead of a fund manager, he secured permanent capital. The cash inside the business was now locked away from the demands of clients. When markets crash and panic-stricken investors pull their money from traditional funds, Buffett remains immune. He is never forced to liquidate his positions to meet withdrawals. Permanent capital allows an investor to wait out storms that break everyone else, waiting for the exact moment assets are at their cheapest. A secure fortress was only the beginning. Buffett needed a way to fill it with cash, which led to his 1967 purchase of National Indemnity. Insurance operates on a time delay. Customers pay cash premiums today, and the company pays out claims much later. The massive pile of cash held between those 2 points is called float. The insurer gets to hold and invest that money in the meantime. Because Berkshire runs its insurance operations with enough precision to generate a profit on the policies themselves, customers effectively pay Buffett to hold and invest their money. Access to billions in leverage at a cost below zero is a structural advantage no traditional bank or broker can match. The 2008 financial crisis was the ultimate stress test. While Wall Street faced fleeing clients and margin calls, Buffett's machine didn't flinch. With permanent capital and ample float, he was the only buyer left standing. He wrote multi-billion-dollar checks to Goldman Sachs and Bank of America on terms that prioritized his safety and guaranteed his returns. Beyond his buying power, he utilized a quiet mechanism to preserve those gains over decades. He reduced his personal tax drag to near zero. Berkshire pays no dividends, so his stake produces no taxable income. He never sells his personal shares to realize gains, and he donates appreciated stock directly to charity to bypass the tax bill entirely. Deferring taxes indefinitely functions like an interest-free loan from the government, keeping billions inside the compounding loop instead of losing them to the IRS. Eventually, the compounding machine ran into the one enemy it could not outstructure, its own massive size. By 2026, Berkshire's cash pile neared $400 billion. The company is now so large it struggles to find acquisitions big enough to move the needle, causing the stock to trail a basic S&P 500 index. Recognizing this limit, Buffett handed the CEO role to Greg Abel in 2025. He kept his dual-class voting shares, ensuring no activist investor can ever break the machine apart after he's gone. While the machine has converged with the gravity of the wider market, its ability to survive intact for 70 years remains a historic structural achievement. You don't need to buy insurance companies to utilize Buffett's logic. Trade a wage for compounding ownership, secure capital that cannot be pulled, and avoid forced selling and taxes. Once you dedicate yourself to building a leak-proof container, the compounding takes care of itself.